Money often feels loud when it slips through your fingers, especially if you're new to investing. Today I'm sharing a plain, practical plan to start with the S&P 500 that you can actually follow without feeling overwhelmed. This isn't hype or a wild overnight luck story. It's a steady, repeatable approach you can set up and forget while you live your life. What is the S&P 500 exactly? It is a collection of 500 large American companies, weighted to reflect their size in the economy. For many beginners, the simple idea is to own a small piece of that whole market. The easiest way is a low-cost index fund or ETF that tracks the index. Today's video will walk you through one specific actionable strategy. It covers when to invest, what to buy, and how to stay consistent. First, avoid common traps. Your plan should start with safety nets like an emergency fund and paying down high-interest debt. Next, decide where you will invest. You can use a 401k, an IRA, or a regular brokerage account depending on your situation. Look for a fund that tracks the S&P 500 and charges almost nothing to manage your money. Popular options include VOO, IVV, SPY, and VFIAX. Mutual funds and ETFs differ in how you buy them, but the core idea is the same. You own a share of the market. This means you don't need to pick winners. You let the whole market grow with time. A key choice for beginners is to keep costs low. A high expense ratio eats into your returns over time, even if the market goes up. Set a monthly contribution you can sustain. The target should not depend on market mood, only on your budget and your time horizon. An easy rule is to start with a fixed amount every month, then automatically invest it. This is the heart of dollar cost averaging. For many people, this means setting aside a small percentage of take-home pay, perhaps 5 to 15%, to put into the S&P 500. The exact number depends on your income, essential expenses, and other goals, but consistency beats intensity. Let's ground that with a concrete example. If you earn $1,000 after taxes, start by investing $50 to $150 each month. Now, automate everything. Link your bank to the brokerage and set an automatic monthly investment day. Then forget about it until the next reminder. When you automate, you practice discipline without having to decide every single month, which reduces decision fatigue. That simple structure is how ordinary people build real wealth over years rather than chasing quick wins. Dollar cost averaging works because you buy more shares when prices are lower and fewer when prices are higher, smoothing out returns over time. It won't predict the market, but it reduces the urge to time the market, which hurts beginners most. The next part is a practical habit, a yearly check-in to review your plan for changes in life, not for chasing performance. If you do this once a year, you keep your strategy intact while your circumstances evolve. During the check-in, look at your balance, your contributions, and the fees you're paying. Only change things if your situation changed meaningfully. A simple rebalance rule is to do it once a year, keeping your target as close as possible. If one part grows much faster, you sell a little of that part and buy more of the others. For most people starting out, the core of the plan is a single, low-cost S&P 500 fund with small, thoughtful additions later. That keeps behavior predictable while still leaving room to learn and grow a bit over time. Most beginners also underestimate costs. Even tiny differences in fees can shave off a big chunk of money after years. Beyond fees, avoid the trap of overtrading, too many funds, or chasing the latest shiny color in the fund lineup. The more you complicate things, the harder it is to stay consistent. A practical lesson is that slow, steady effort compounds into real growth, while fear and greed usually pull you backward. Treat investing like planting trees. You water, you wait, and someday you enjoy shade. If you want more variety, you can add small international exposure or a bond sleeve later, after your core is established. The key is to keep the core strong so you aren't tempted to abandon your plan during a bad week. Choosing a broker matters, but not in dramatic ways for most beginners. Look for easy automation, reliable execution, and friendly fees. Now imagine you start today with a modest budget and a patient mindset. In 10 years, steady contributions can feel like a small miracle. The bottom line is simple: diversify, control costs, automate, and let time do the heavy lifting. If you stick with that, you'll have a practical advantage over most beginners who chase flashy stories. I'll repeat this in a moment, but here's a quick, practical plan you can write down tonight. Open a low-cost S&P 500 fund, decide a monthly amount, set up automatic investments, and schedule an annual review. That's enough to start without feeling overwhelmed, but powerful enough to build real wealth if you stick with it. The trick is consistency, not brilliance, over many years. So if you're watching this as video number 166 in a simple investing series, know you're not alone. People just like you are choosing a boring, reliable path instead of gambling on quick wins. As you build this habit, you'll notice the difference between intention and behavior, and the gap closes with time. That is the quiet magic of investing that lasts longer than any hot tip. If this resonated, please like, subscribe, and drop a comment with your questions or experiences.